The first major change that came about regards taxpayers' ability to claim a deduction for interest on income from residential property. The change established that interest cannot be claimed for any residential property purchased on or after 27th of March from October 1st onwards. The changes also meant that property purchased around this period would count as being acquired when a binding sale and purchase agreement has been entered into between both parties. The interest deductibility change mainly aimed to increase the ease of access to first home buyers as it reduces rising pressures on house prices, which solves a lot of the housing affordability crisis that's happening in New Zealand. However, for properties acquired before 27th of March, the investor's ability to deduct their interest will be processed by a slow phase-out approach over the next 4 years. As illustrated on the table, for each year, the deductibility is reduced by 25% until 2025. Properties that meet a special condition can still be exempt from this new change, with the exception of new builds. The condition is that properties that have received their code of compliance on or after 27th of March, interest from new builds is eligible to be deducted for 20 years from the point that a code of compliance is certified, which is also issued for the property. The exemption is also transferable to any new owner within the exemption period. Properties not suitable for residential living, such as offices and shops, will be free from this change, as well as care facilities, such as hospitals and private residents. Although this exclusion only applies if the home is used to earn income in a sense through flatmates or boarders.
So the Bright Line test covers residential property and it is found under Section CB6A of the Income Tax Act 2007. So when it was first introduced in October 2015, residential land disposed within 2 years of land transfer being registered was considered to be income. The government then extended this to 5 years from March 2018, and now they've changed it so that from the 27th of March 2021, the Bright Line period has been extended to 10 years. This change, however, is not applicable to new builds whose Bright Line period will remain at 5 years. So under the Bright Line test, if you sell residential property within the Bright Line period of acquiring it, any profit you will make will be taxable income. And the length of this Bright Line period depends on when you acquired the property. So if the property is acquired in between the 29th of March 2018 and the 27th of March 2021, the 5-year Bright Line period will apply. However, if you acquire it on or after the 27th of March 2021, the 10-year Bright Line period will apply as a result of the recent changes. So this just means that if you make any profit, if you sell your residential property within this 10 years and you make a profit from this, that profit will be taxable. So properties that have been transferred on death of the owner or under a relationship property agreement, which is basically just inherited properties, are still exempt from all Bright Line tests. So the recent changes haven't changed this. And properties that have been the owner's main home for the entire time they owned it is also still exempt income. However, a change of use rules may mean that they are still subject to paying tax, and Zarin will discuss this in the next slide.
Leading on from what Ashley discussed, for properties acquired on or after the 27th of March 2021, the change of use rules will come into effect, which means if the sale of your property is subject to the Bright Line test and you do not use the property as your main residence for 12 months or more, you will be required to pay income tax based on the period that you are not using the property as your main home from the property increasing in value. Therefore, Marcus will have to pay a proportion of income tax based on the profit he made for the sale of the Queenstown property. This rule also applies to new builds. The change of use rules also doesn't allow property owners like Marcus to claim interest on loans used for residential properties as an expense against the income from those properties, which means he cannot offset the interest expenses against the rental income when calculating his tax. The calculation for change of use rule, if it applies, is shown on the slide above. Properties acquired before the date are exempt from change of use rule. My recommendations for Marcus, since he will be subject to the change of use rule, is that he can claim any operating expenses from his investing property, such as repairs and maintenance, not including renos that substantially improve the property value, rates and insurance, professional service fees such as property managers and accountants, and depreciation on capital expenses such as appliances and heat pumps. I will now pass it on to Marshall to discuss the property in Queenstown.
All right, as Zarin just mentioned, I will be discussing whether or not the profits from the disposal of the developed and subdivided property in Queenstown will be taxable. I'll go through each possible section and explain my reasoning. Let's start with section CB6. This would not be applicable to Marcus because he did not acquire the property with the intention of disposing it for profit. Rather, he wanted it as a business premises. Section CB6A is likely not applicable either due to the property being acquired in 2013. There does not appear to be a relevant bright line period for this year. We can paint section CB7, 9, 10, and 11 with the same brush. They all require the taxpayer or someone associated with the taxpayer to be involved in business relating to the relevant transaction. Therefore, even though each section relates to an aspect of Marcus's activity, such as the dealing in land, the development and subdivision, and the erecting of buildings, neither Marcus or anyone associated with him has ever been in any of these kinds of businesses. Now we come to CB12. This is the section that appears to cover this transaction. For this section to apply, there must be an undertaking or scheme. It must not be minor in nature, and the development must commence within 10 years of the land acquisition. Marcus began an undertaking when he began construction in December 2013. I judged this with guidance from the Cross and Golding case, where a key distinction was made between the preparation for and the implementation of an undertaking. It is clearly not minor in scale, whether we look at it relative to the land investment or overall. The 980,000 is large. It is also clearly within the 10-year restriction, as Marcus began construction at the end of the same year that he purchased the land, 2013. Therefore, I would say that it would be most fitting to treat the profits of this disposal of this property as income under section CB12. This in turn makes section CB13 not applicable, as it requires that an amount mustn't be found to be income under any other section of the Income Tax Act for it to come into effect. I'll leave Cushy to discuss whether any exemptions will apply to this income.
So continuing on with what Marshall was just discussing regarding the land in Queenstown, there are a variety of applicable exclusions for this land. So CB12 states that the following can exclude the proceeds from the sale of land from taxable income. Section 17, 20, 21, and 23 all do not apply for various reasons. So section 17 is not applicable in this case as the land purchased is not residential. And section 20 does not apply either because the land was not developed with the intention of Marcus carrying out business. Section 21 does not apply either as the land is not farmland. And section 23 does not apply because Marcus developed the property for investment reasons and so for investment purposes. So section 17, 20, 21, and 23 are all not applicable in this case for the land in Queenstown. Next, Jessica will discuss the property in Auckland and the interest deductibility regarding this.
Thanks, Cushy. I will be covering how much interest you can claim on your property in Auckland as an allowable deduction for the interest tax years 2021 to 2026. As you purchased this before 2021, you are able to claim some allowable deductions. On the left is a table listed on inland revenue of the percentages. I've broken this down into interest per annum, which is 18,000, and interest per 6 months, which is 9,000. In 2021, it is 18,000 times 100%. In 2022, it is broken down to two calculations of the 9,000 times 100% and the 9,000 times 75%. In 2023, it is 18,000 times 75%. In 2024, it is 18,000 times 50%. In 2025, it is 18,000 times 25%. And 2026, it is 18,000 times 0 because you cannot claim any deductions that year. And that will come to a total of 60,750. In conclusion, in this presentation, we have covered 3 key changes to taxation on residential property. That is interest deductibility, bright line test, change of use rules. We covered Queenstown property, the taxable income and exclusions, and this resulted in it being taxable under section CB 12. And then in the Auckland property, interest deductibility is overall 60,750. And that will conclude our presentation.